Okay, welcome everybody to the webinar. I appreciate you spending some time with us today. My name is Clay Malcolm here at Advanta IRA, and I'm joined by my colleague, Corey Dayharsh. Corey, hi, how are you?
Thanks, Clay. I'm doing well.
And a special guest today, Jerry Schlickburn of Dream Vesting Capital. How are you doing today, Jerry?
I'm good. Thank you for having me.
Well, we're delighted to have you, and I appreciate you bringing some of your expertise in terms of the way to dissect single-family rental or single-family kind of investments for IRA investors and for those who are investing money other than their IRAs as well. Appreciate you spending some time with us. For those of you who are new to these presentations, if you have questions along the way, please do feel free to type them into the questions box. You should have that on your console from GoToWebinar, and we typically will take those questions at the end. But go ahead and type them in as they occur to you. For the presentation today, we're going to start by talking a little bit about the nuts and bolts of how IRAs acquire real estate and also make moves with them, because of course in a self-directed IRA, the investor is the one who makes the decisions, and so you're going to have decisions along the way about how to manage the property or the investment that you have and things like that. So we're going to talk about some of the key components to making those decisions when it comes to real estate. And then also, and then at that point, at the end, we'll turn it over to Jerry, and she can talk a little bit more about the inner workings of an investor and what you might choose to consider in terms of how do you treat the property in terms of, are you going to fix it? If so, how much? And then are you going to sell it or rent it, or all of those things? One of the things that's been interesting about this real estate market being the way that it is that it seems like more and more I hear investors talk about the fact that they need to have plan A, plan B, and plan C just in case, because there's so many things that are not usual, so to speak. So I think people are taking more time to understand their options and also to evaluate them as they go, so that they can make a decision and an ongoing decision that's best for their investment. So that was kind of the reason that Corey and I decided to choose this topic for a webinar, and then we were lucky enough to get Jerry on Jerry's schedule so that she can give some of that insight. So without further ado, let's go ahead and get into the slides and start talking a little bit about the IRA part, and then as I say, Jerry will pick it up kind of toward the middle and talk more about the investor inner workings. All right, well there we are, the three of us. There's our contact information, and we'll show this again at the end. So if you do have follow-up questions after the webinar, please feel free to contact us. We're happy to be an information resource for you in terms of anything that we talk about today, and just kind of general questions with IRA investing and real estate investing. All the information that we're going to give today is for education purposes only. At Advanta IRA, we actually don't give any tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. And we certainly encourage you to use your financial team and legal team anytime that you're considering an investment for your IRA, or for you personally, for that matter. As a self-directed IRA provider, our role in this equation is a pretty neutral one. Again, we don't give tax, legal, or investment advice, and the account holder is really the one, as I mentioned earlier, that's making the decision. So choosing the asset, doing the due diligence, that part does fall on the account holder in a self-directed IRA. And then also managing the investment through time. And so again, this presentation is all about having that ability to invest in real estate, but also the knowledge of how you would manage it through time, and that's what we're going to focus on today. And at Advanta, I will say this, it's a company that is built on customer service. So we're actually structured in a way that every account holder gets an education type person like Corey or myself, as well as a back office account manager that's dedicated to their account. And that account manager typically helps them with investment paperwork, account balances, any kind of behind the scenes account questions that might come up. And you certainly have our phone numbers and our email addresses and all that kind of thing. So if at any point you have questions about what's going on in your account, or a question about a prohibited transaction or something like that, you know who to call and how to get the information. Well, at Advanta, we're kind of a medium-sized company in the space, and I think that positions us nicely for customer service because we've seen everything. We're big enough to have seen everything, but we're also not too big that you don't have somebody's phone number and their email address and know who to call. So that's really the way that we approach the project of being a collaborator in your self-directed IRA investment strategy. And I know that I can speak for myself. I've been a self-directed IRA investor myself for about 10 years. And so I really kind of intimately know the process of how do we assemble paperwork and what kind of timetables we need to adhere to and that kind of thing. And so I'm used to the process and I enjoy the process, and I'm happy to help, guide people through that as well. Now, when we're talking about what is a self-directed IRA, there is some vocabulary things that can sometimes trip people up, but really what we're talking about is an account that handles alternative assets. So we're talking about combining the tax advantages of the account type with alternative assets. And the things that really comes out as we talk about that combination are the fact that in a self-directed IRA, the account holder is the one who's making the decisions. So talking about what property to buy, how to manage it, so on and so forth. And so at its very core, the account types don't stay, the account types stay exactly the same. So these account types that you see on your screen, those can all own real estate, since we're focusing on real estate today. And the idea is that the rules for these accounts, the contribution rules, the distribution rules, and the tax advantages all stay the same as you're familiar with. The thing that is different when you have an IRA at a self-directed IRA provider like Advanta is that instead of that money, once it's inside the account, instead of it buying a stock or a mutual fund, it's going to buy real estate or any number of assets that the IRS allows. And that can be things like cryptocurrency and precious metals and private equity and so on and so forth. Today, we're really going to focus on real estate assets, and even in that broad categorization, there are a lot of things that you could have your IRA invest in. So it could be single family homes, and obviously the management of that can be a number of different strategies. It could be condos, mobile home parks, any of the financial instruments that are associated with real estate, so tax deeds, options, things like that. Private lending that's associated with real estate is also a possible asset class for your IRA. REITs, and when we talk about real estate, lots of times we're also talking about these small entities, so syndications or private equity, where somebody is collecting investors that are going to go out and buy a bigger asset. So whether that's an apartment building or an office building or storage facility or something like that. So the thing that's important, I think, for you to know conceptually is that, again, these account types that with those tax advantages can be combined with the returns that you can get from investing in all these different real estate assets. And the great thing about, I think, self-directed IRAs is, first of all, you get to use your own expertise, but you also get to use the expertise of the people that you trust. So that could be your real estate team, your attorney, your CPA, your friends, but usually the people that we deal with have a real estate and an investing team, and if they don't, they assemble one. But you get to actually work with the people that you know and that you trust. And obviously, again, you're combining that with your IRA's investment money. And so that's an important part of the equation. But even though it is self-directed IRA and you as the account holder have some additional responsibility for activities, that doesn't mean you have to do it alone. You get to use the team that you know and trust and employ their expertise along with your own for the investment strategies that you're going to use. Now I'm going to bring Corey back at this point, and we're going to talk a little bit about the 4 elements or the 4 actions that are kind of primary actions when it comes to IRAs investing in real estate. And Corey, I'm going to go ahead and switch this slide. I'm going to give you the keyboard and the mouse, and I'm going to let you take it away from here.
All right. Thank you very much, Clay. I appreciate the introduction there. So everybody, right now, I'm going to start with the agenda of going over how to invest into real estate within your self-direct account, some of the concerns that you should have, and information you should know about real estate investing within a self-direct account, and then also how to inevitably sell that property out of the self-direct account. And once I go over that aspect, I'm going to go ahead and turn it over to Jerry, and Jerry's going to be able to help kind of go over strategizing which route to go once you have the property in the account. If you're going to rehab it and hold it, not rehab at all, or rehab and flip, We'll go into that as well. And then we'll wrap up, as Clay said earlier, with a Q&A session at the end. So please feel free to jot your questions down into the questions box. We will get to those at the end of the session. So the first step here in this context is buying the real estate within the self-direct account. As Clay mentioned and showed you on one of the previous slides, there are plenty of different options for real estate investing, whether it's a single family home, multifamily home, mobile home park, commercial property. You basically set up the self-direct account, or if you've already got one set up, then you just utilize that. You enter the contract in the name of your retirement account, as we've got displayed here. It'll be something along the lines of Advanta IRA for the benefit of your name and your Advanta account number. That is what will be recorded on the deed of the property, so that there's no misconstrued you personally owning it versus your retirement account. It's very clear cut. Once you have the property under contract, you work with your dedicated account manager at Advanta, like Clay referenced, to actually get all of the contractual paperwork and the closing processed in the name of your IRA account. All of the funds for the real estate must come from your IRA account, or at least all of the funds from the portion of ownership you take in the IRA. I bring that up because you can partner with business partners of yourself, or even yourself individually, as long as you go into the contract of the real estate with the expressed percentages that each investor will hold in the real estate. And keep in mind that that also means all of the expenses and income must be split by those percentages. So for example, if you're looking to buy a property, 50% in your retirement account and 50% out of your personal pocket, then all of the expenses and all of the income go back 50 for 50 into the IRA and into your personal pocket. Also, one thing to note is all of that income and expense, not expense really, but all of that income goes back into the IRA tax-free. The only capacity you would really need to pay any taxes is if it's a traditional style account later on when you distribute that money out of the IRA. So if it's a Roth and you own real estate in it, and then you sell that real estate, no such thing as capital gains tax, no tax at all for whatever you've generated from that real estate holding. As far as paying bills for a retirement-owned property, they are all paid by the IRA unless it's split ownership, like I just mentioned. You can submit the invoice to your client account manager and we'll get that processed the very next day. Or alternatively, we have a client online portal. You can sign in at any time, submit a bill payment request, and we cut that out the next business day. If you are one of the persons that would prefer to have a property manager for your IRA asset, you can definitely do that as well. The way that works is the property manager typically collects all of the rent, pays all the bills, and then they send the residual income generated back to Advanta to add to your IRA bucket of undirected funds until you're ready to place another investment. So either way, you can work where you're kind of managing the property in a capacity along with Advanta, or have a property manager employed for that property, whatever is in your interest and your preferred method. Now with maintaining the property, there's a little bit more stipulation. As an IRA account holder, you cannot commit any sweat equity to the property per IRS rules and regulations. So we've got some examples here. It's really down to even changing a light bulb. You're not allowed to do that. You would have to outsource all of that thing. I typically speak to my clients and basically refer to them as a general contractor per se, where they get to pick all the service vendors that they want to use, inspect all the work, make sure everything's done to quality. They just can't physically do any of that themselves. There is no specific guideline for qualification. So if you've got a general handyman that's just, Bob up the road that you already are using for other things, you could continue to use that person as long as it's a non-disqualified person. Disqualified persons in this capacity are your lineal descendants and ascendants, so your parents, your children, and your spouse. So aside from those individuals, you can really have anyone else qualified to do the work go ahead and do that for you on your IRA-owned property. As far as renting the property out, all of the cash flow, same as expenses, have to come directly through the IRA account. So when the IRA owner decides to start renting the property, They could either work with an agent to find a leasee or a tenant, or they can find it themselves. The contract between that leasee or tenant is between the IRA account and that individual. So you might coordinate who you'd like to rent the property, then you bring that contractual document to Advanta. We'll execute it as the custodian, and on behalf of your retirement account, we'll hold a copy of that for good measure. And you, again, can either do that directly with Advanta, or you can have a property manager kind of in place to help with that side of it. All of the money comes either back directly into your IRA account, so your tenants would make payments to the IRA directly and mail them to Advanta, or they would make payments to that property manager. And again, the property manager would forward whatever is left over after they pay their expenses and hold their bucket for you back to your retirement account. Now, selling the property is very similar to purchasing it. You, again, as the client in all of these scenarios, determine the terms of the contract and the terms of the agreement. You provide that contract and paperwork over to Advanta to execute on behalf of your retirement account. Again, for example, Advanta IRA, for the benefit of your name and your account number. One of our authorized signatories will execute that paperwork after you as the client have approved everything and deem it to be in good order. And then the sale proceeds flow right back into the IRA account. If it's a real estate closing, it's typically either a check cut and mailed to Advanta's office for deposit, or a wire, depending on your preference there and how quickly you'd like the money to get back into the account. And again, that all flows tax-free. The only capacity of taxes in this case would be a traditional style account. Later on, when you distribute out of your retirement portfolio, you'll have to pay taxes at that point, obviously. So that kind of gives you a gist of what it's like to find a property, purchase it within a retirement account, maintain it for any duration, whether it's just long enough to fix and flip, or if you're going to update it and then turn it into a long-term hold for rental income, and then also selling the property. So now that I've gone over that with everybody, I'm going to go ahead and turn it over to Jerry. And Jerry's going to go into a little bit more of the strategy involved with deciding what properties you want to fix and flip, what properties you might want to not fix at all, and what properties you might want to hold for rental income. Go ahead and take it away, Jerry.
Thank you. So thank you, everybody, for I'm excited to be here speaking at this event. We actually work a lot with people who have self-directed IRAs. My husband and I have had a self-directed IRA that we invest in real estate, and we're really set up to help people be able to do that. A little bit about myself. I'm actually a licensed broker in 3 different states. I am the founder of Dreamvesting Capital Group, and my husband and I own the other companies that you can see below, which are Orange Property Management, the construction company, real estate company, and roofing company. Together, my husband and I have flipped about 300 properties over the past 10.5 years, and we have a rental portfolio amongst all of our businesses of, give or take, it's always changing because we sell and buy all the time, but about 135 rental units. So I wish that I could give you all a crystal ball on how to determine whether to keep a property or to flip it, but there's really not a crystal ball. It really depends on your strategy and what you're looking for. I'm going to come back to this property. I'm sorry, I apologize. So let's start, I'm going to go through the slides with some questions that Clay had asked me to speak on. And so when we talk about finding an investment property, there's so many different ways. Obviously, one of the first things that Clay talked about is having a team of a team of people around you to help in the real estate aspect. And so the first thing that comes to mind are realtors and our MLS. And in a seller's market, the MLS is not always the best way to find an investment property because they're priced very high right now. So you really want to work with somebody who can find off-market properties. And you can do that yourself. One of the first ways that you can easily do that is public records. Every thing that happens with real estate is public notice. So if somebody is 30 days behind on their mortgage, it's actually public notice. And every city, every county has a register of where those get notified. In my main area of focus, which is Omaha, Nebraska, we have a newspaper that publishes everything, whether it's 30 days late, maybe somebody is recently deceased and their properties are going through probate. All of those things are published there, and those are, often people that need help and need a solution for their real estate. And as an investor, you can be somebody that can do that, and really help guide people through a difficult time. One thing that's become really popular in the last 5 to 10 years is wholesaling. And this is where you or somebody maybe who doesn't have a real estate license, approaches a seller or a family member, or somebody comes to you and they have a property that they want to sell or they need help with, and you buy it off market. So typically for a lower price than what you would buy it on the market, and that's called wholesaling. Once you own the property, you can keep it or you can sell it to somebody else. Or there's another new strategy that's really become popular in the last couple of years in the seller's market, and that's called wholesaling, where you buy a property wholesale off the market. So you're buying it for a lower price from somebody that you know or you've met, and then you turn around, usually without doing much work, if any, to the property, and you just list it on the MLS with a realtor. And oftentimes, especially in a seller's market, there's such a big difference in what people will pay for it on the market versus off, that you can make a nice profit there. And then, of course, there's websites like Craigslist. People are always advertising that they need to sell their homes on Craigslist. And usually if they're on Craigslist and not the MLS, it's because they are embarrassed to show their house. Maybe it's not in a great condition, or they need to get out of it quickly and they're looking for somebody who can pay cash. And a lot of times with your IRAs, you guys can pay cash. There are ways you can partner with a lender and get financing, or partner with somebody like me. We've partnered with a lot of people who have self-directed IRAs. But Craigslist is often a great place to look. I do not have Zillow on here. Please notice that I do not have Zillow on here. They're not a good place to look for investment properties typically. Zillow publishes everything that is a public record as a property that's for sale. That doesn't mean it's for sale just because there's a 30-day notice of default on the property. So we get new investors all the time asking us about properties that say they're for sale on Zillow and they're actually not for sale. So I don't recommend that. What I do recommend highly now is different apps that are called Driving for Dollars apps. And these apps are really cool. You literally can drive by and you see a rundown property, you can snap a picture of it and pin it in the app with the address, and it will bring up the owner's contact information, and you can easily contact the owner that way and say, hey, I noticed that you have a property here that looks like it needs a little bit of work. Would you be interested in selling? It's as simple as that. So there's so many different ways to look for investment properties. There's also just as many different strategies when you're trying to decide what you want to do with the property. Like I said, I don't have a crystal ball. I can't say what your goals are for you. You need to know those. So my very first point here is know your goal, or, know the purpose of this. Are you wanting to build cash fast? In that case, you probably want to flip the property. Or are you wanting to build equity in the property long term and maybe even pay off the mortgage and have a completely debt-free property just kicking off income every month? A lot of people fund their retirement that way. So it's really up to you. Like I said, my husband and I have flipped about 300 properties. And in the beginning, we pretty much flipped everything because we were trying to build up our cash so that we could do a lot of properties at once. When we first started out, like everybody else, we started with one property. Of course, I'm a realtor and he's a contractor, so we bumped that up pretty quickly to where we were doing 3. And then by building our cash, we got to where we were doing about 7 at a time. And that's how we've done such big numbers. Today, we are focused on growing our rental income and our rental income for our investors. So we look at every property, and I'll show you my pro formas in a second, but we look at every property, and with all of the numbers figured in, if we can profit $200 per month, we typically keep that property. Now, everything's for sale. If somebody came along and offered me a number I couldn't refuse, I'd probably sell it and go buy another one. But there's, it's really up to you what you're going to do with the properties that you own. My biggest point in any type of investing is to know your numbers. And here I'm actually going to show you a couple of pro formas that I have pulled up. These are actual pro formas that we use. As you can see, this is a pro forma I use for flipping properties, and it has 4 different sections on the worksheet. The buying costs here, which include my purchase price. I break out my down payment if I'm getting financing, my closing costs, because every time you buy real estate, you have taxes, insurance, etc. that you have to pay, and then any commissions that I'm paying. So I have my total cash in and my total purchase price. These are different because if I'm getting financing, my cash in is my down payment, not my total purchase price. The next section over here is loan assumptions. If I am getting financing, I put my loan information in here. I have a hidden calculation here that calculates out my monthly payment. Then I have my holding costs. This is where I see new investors forget numbers all the time. If you have a property sitting that you own, you will be paying every single month insurance, utilities, and if you have interest on your mortgage, you'll be paying that every single month, whether you're doing something with the property or not. I put my months in here, and then it calculates how many months I'm going to keep this, what my insurance, utilities, my rehab, and then if I'm going to pay for marketing and staging, which I always stage my flips, and then my total holding costs. And then that brings us to the 4th quadrant, which is my sales cost. So here I have my sales price, again, my closing costs, commissions that I might be paying. And if it's a buyer's market, I figure in a 3% seller concession. In a seller's market of today, nobody's really asking for that. But in a normal market, I would figure that in. And then the net is the purchase price minus my cost. And then my total profit subtracts my purchase cost and my holding costs, and this gives me my profit. As you can see, profit numbers today are very low. So in this one, I would try to keep it, and I would use my rental pro forma, excuse me. I will make these available too. If anybody's interested, you can message me. I'll show my contact information again at the end, and I'm happy to send these to you. But here's same thing, purchase price, loan assumptions, and then I have annual costs here. I do have property management. So I have property management fees, and then of course I have my insurance and taxes, my mortgage payment, utilities. I see a lot of people never include utilities on a single family rental, but if that property is vacant for a day, you're paying the utilities, not your tenant. So I always figure in some amount for utilities, and then cleaning and maintenance. And then over here on the rental side, I have my gross rent. Any other income, for example, if you have coin laundry or you have garage maybe that you rent to the tenants. And then vacancy, we typically use a 10% vacancy. And then you have your effective income minus your expenses from over here, and that gets you your net operating income. So your monthly and annual. And you can see here that my net operating income is almost $380. So that's a property that I would personally keep. And of course, like I said, it's always up to you. Everybody's goals are different. And that's something that you'll have to determine. So knowing your numbers, you really need to know your comps. Again, don't use Zillow because their comps are off, give or take easily 10 to 20% high or low. I also say not to use your assessor's website. Some cities' assessor sites are very accurate. In Omaha, they're becoming more accurate, but we also work in another town that's near to Omaha, Lincoln, Nebraska, and their assessor numbers are way off. They're very low compared to what the value is on the market today. So this is where a realtor comes in extremely handy, or maybe you know the area and you're very familiar with the real estate, and that's fine too. So you want to know your comps. You want to know your ARV, and that stands for after repair value. So my property is worth $50,000 as it sits today, but if I put $40,000 into it, maybe it's worth $150,000. So you need to know those numbers. And then of course you need to know what you can rent it for. We use a website called Rentometer. That's very accurate. And believe it or not, I'm going to recommend Zillow here for rents. Their rental numbers are really accurate. They don't give you a rent number, but you can go in and see what other similar properties are renting for in that area. So those two websites are great for knowing your numbers. So we talked about the pro formas. I guess I already went through this slide, so I won't go through that again. But again, if you are interested in using those pro formas, let me know. I will say that here's a place where investors get really in the analysis paralysis. There's a lot of pro formas out there that will help you calculate rent pay down, which is great. But I just keep in mind that over the years, I'm going to gain equity because the market is going to hopefully appreciate. Real estate always appreciates, although there are areas where it doesn't really. So you want to know your areas. And then also your tenant is paying your mortgage. And so you're going to gain equity just from the tenant paying down the mortgage through their rent. Now, of course, they're not paying your mortgage, you're paying your mortgage, but your mortgage is getting paid by the rent that the tenant is paying. To me, those are extra. Those are the cherry on top. I want to know personally, what's my cash on cash return? So I like to look at just those numbers. But when you're maybe analyzing your rent portfolio year over year, you might add in those other equity gain and rent or mortgage buy down, and you'll see the true value of investing in real estate, which is really exponential when you start to look at those numbers. But when you're just trying to decide if you want to flip or keep a house, and you maybe have a couple days to decide when you're trying to buy a property in this market, things go so fast. You might have a couple hours. Don't get in the weeds on all that stuff. Just go quickly through a quick pro forma like what I just showed you. Here I'm going to show you a couple of examples of what we do. I've got to move my control panel to see all of this. So these are some actual numbers on some properties that we recently did. And so I have the property address, so you can go and check that I own it, and even the location if you want to. The price is the price that we paid for it. The rehab is how much money we put into each property. And then the rent is what it actually rented for, and how many days from the date we bought it until the date it was occupied. So in most of these cases, they were rented before they were occupied, but once they're occupied is typically when the renter takes over utilities and starts paying rent. So I need to know how many days I had to pay for that because it affects my numbers in the long run. So you can see here, most investors will look for at least a 1% on their purchase price. So rent being 1% of the purchase price. So just for round numbers, if you pay $100,000 for a property, or you have $100,000 into a property, you want your rent to be a minimum of $1,000. Now, it depends on what city and what state you're in. Everywhere is different. For example, I'm also licensed broker in Arizona. And in Scottsdale, Arizona, you cannot find a 1% rule generally. If you can, you should absolutely buy it. However, while their rent is lower than what I would like to see in Omaha, their homes appreciate exponentially faster than what we see appreciation in Omaha. So it's a give or take on cash return versus appreciation. But for us in Omaha, we like to see a 1% rule. And as you can see, we've done way better than 1%. We had $65,000 into this house and it rented for $1,080. On 2120 Wirt, we had 105,000 into it, and we rented it for 1,600. So those numbers are much better. I added 3910 Dewey here because it's a unique property. This is a short-term furnished rental. It's a 6-unit conversion, meaning it was originally built as a single-family home, but 80 years ago, they converted it to a multifamily. Now has 6 units that we rent typically to traveling nurses who tend to stay 3 to 6 months. And then we also use websites like Airbnb. So in this property, we have $225,000 into the property, and we rent it for about $11,000 per month. So the numbers on that are just incredible. And I would encourage you, depending, again, it all depends on the location you're in. But if you're in a location that you can do short-term furnished rentals, it's definitely a good idea to look at it. Now, I will preface that you also have to always look at worst case scenario. Whenever you buy a property, you need to have 3 exit strategies. So you should be able to sell it for more than you have into it. That's one exit strategy. You should be able to rent it on numbers that make sense to you. And then in this case, we do short-term rental. So the short-term rental numbers are amazing, but if COVID happened again and nobody was traveling, can I rent that building long-term and still cover my expenses? And in this case, I can. In some cases, I can't, and then I wouldn't purchase it. Here are some numbers that we've done on flipping houses. And I'll just say that when we first started flipping, we looked for numbers more like that middle one, the 3515 Pacific. We liked to get at least $20,000 to $25,000. Today, if we can flip a property for $5,000, we would buy it. That's how competitive our market is. But again, if I could keep that and rent it for $200 a month, I would do that. So again, it really depends on your goals. But you can see here the prices, the rehab numbers, and then how long we held those. So the hold means, again, from the date we purchased it till the date we no longer owned it. So the actual closing date, not the date it went under contract. And then this is my actual profit. Now, I will tell you that some investors don't use a realtor to sell. They maybe do some of the work themselves. When you're investing with your IRA, you can't do the work, so you do have to use a contractor. I believe you could sell it yourself as long as there's no commissions involved, but if I'm incorrect on that, Clay or Corey can correct me at the end here. But we use realtors, we use our realtors, and we use our contractors. So this is our actual profit that the investor side sees. And one thing in our area, what we've analyzed this over the years, but we make less profit, and definitely a less profit percentage-wise on the higher priced homes than we do on the lower priced homes. So while HGTV makes it really, cool to flip a mansion, in Omaha, a mansion is, anything above $500,000. We're very conservative on our real estate prices. But that sounds exciting, but we typically make maybe a 5 or 10% cash on cash return, where if I go into some of these smaller lower priced home neighborhoods that maybe you and I wouldn't necessarily want to live, but first time home buyers are definitely buying these homes, I can pay, well under $100,000 for a house, not have to put much money into it, and see a great return. So if you look at, this is my biggest home run ever, probably. I had $26,000 into this house and we made a $12,000 profit. And I think we did that in 2 months. But you can see $12,500 is an incredible cash on cash return for $84,000. And it's only a 3-month hold. So that means I can do that 4 times in 1 year. So I don't know that I should have calculated this number, but say my cash on cash return is 20%. and I flip that same money 3 to 4 times in 1 year, that gives me a 60 to 80% cash on cash return in 1 year from flipping. And so that's why I say you can really make a lot of money flipping. But again, depending on your goal and the area you're investing, I have a friend in Scottsdale who just sold a house. Their client bought it last year, renovated for $530,000. They put no money into it, and they sold it this year for $830,000. $300,000 return on a $530,000 purchase. And so we can't do that in Omaha. So that's not a strategy that I look for, but if you were in Scottsdale, you would want to look for something like that. I'm going to go through some pictures and also talk about what we fix and don't fix. As you can see, this is a lovely before picture. That's a living room. In this case, we did the entire kitchen. You definitely want to renovate kitchens and bathrooms. That's where your highest dollar is. Some people will say to replace windows, and we don't replace windows unless they absolutely need it. That's not something that we get a return back from in our market. We definitely do the roof if it's shot. If it's not shot and there's another 5 years, we don't do the roof. We a lot of times leave those kind of things for the buyer to negotiate in their inspection period if they have one. So this was that property. We purchased it for $175,000. Our rehab was $82,000, and our profit was only $14,000. Here's the after pictures of that property. Depending on your price point, we do recommend doing granite, but we don't do full granite slabs. We do granite overlays. So there's things you can do that make the house look just as nice and cost the same as doing something more expensive. Do the less expensive way when you're the investor. You know, don't cut corners, don't leave, you know, electrical or plumbing undone. All those things should be fixed. You know, you don't want to be greedy and cheat people out of quality, but you know, you're an investor, and it literally comes down to the numbers in the end. This was one of our only IKEA kitchens. We don't have an IKEA in Omaha, so we had to go get that, but it was really cool. So you can see how much change we do in most of our flips. These are all before and after pictures of our flip houses. I don't have our rentals in here. Our rentals are a step below. We don't put granite countertops typically. If there's wood floors, we typically always refinish the wood floors, whether it's a flip or a rental. Wood will last longer than vinyl and longer than tile. So rip out the carpet and keep those floors. It's definitely worth it. We do tend to put a luxury vinyl tile or vinyl planks in them, whether they're a flip or a rental, because they're easily replaced in a rental. It costs less over time than carpet does. We do not always do cabinets and things like that. If we can paint the cabinets, we paint the cabinets. You really need to, when you're working with a contractor, you really need to work with somebody who can help advise you in those areas. A lot of contractors, or like my husband, when we first started out, he was very, very proud of his work, and he did great work, and he wanted to always do the best of everything. But we quickly realized, you know, we don't need to lay new tile in the house. We can do luxury vinyl plank, and people love it just as much, and it's a lot cheaper for us. So we had to start, you know, really analyzing things like that. You don't want to go overboard when there's something just as well that's a less costly alternative to you. So again, here's my contact information. Feel free to reach out to me about those pro formas. I also wanted to offer, I do have a mentoring program for my realtors and new investors. And if that's something you want to be part of, we do meet in Omaha, but we also do Zoom. So I'm happy to do that. And that's a platform where people can ask me any questions, and I'll answer whatever questions come up. So Clay, I'm finished if you want to take back over.
Thanks a lot, Jerry. I really appreciate that. The pictures I thought really brought it home. It seems like that in a lot of cases, you really are kind of going back to, I mean, stripping that a lot of it down and starting over in some cases. Yeah.
Yes. Yes, a lot of times we are, or a lot of times it really looks like we are, you know. Obviously, we try not to go like, we try not to go clear down to studs, you know, re-drywalling a whole building costs a lot of money. But at the same time, you have to keep in up with what's currently popular with buyers. And so, you know, sometimes like this is an older home. Can you still see my screen?
Oh no, sorry, I took it back.
Oh, that's okay. That's fine. So if it's an older home with that character, we don't necessarily open it up. But if it's a newer home, like built in the 70s or later, we try to make, you know, do like the great room floor plan that everybody really loves today. And so in that case, you might be, you know, opening up and adding a beam, which can be expensive. But you really have to analyze all the options you can do. And then every investor always laughs because we look at it when you, especially when you first start out investing, you look at it like, how would I want it if I was going to live there? And
Right.
then you go really over the top. So what we actually started doing was we do the house and we sell the house. And then we say, hey, if we were going to live here, we would have done these, you know, we would have made the deck bigger, or we would put sliding doors here, or whatever it is. And then obviously we own the construction company, so, you know, we can price that out for people. But, you know, people usually understand that you can't do every single thing that you would have done if you were going to live there. But you still
Got it.
have to make it nice. And usually if you're buying the houses right, that means it's a lot of work. Our average rehab on a flip these days, it used to be $40,000 to $50,000, and now it's about $75,000 to $80,000 average. On a rental property, our average is can be 10 to 30,000, so say 20,000 when we initially buy them.
And is the difference in the recent numbers, is that because of the building materials have just gone up so much, or what is the?
Yeah, that's mostly it. If you guys aren't aware, you know, a 3/4 inch piece of plywood 2 years ago was like $9, and today is $35, $40. So the
Incredible.
prices have just went up astronomically. Um, you know, everything's going up now. But then not only that, but finding contractors and subcontractors. That was a problem that started, you know, 10 years ago. It's just that a lot of the guys, mostly guys, but people who do that work don't want their children to do that heavy manual labor. They want them to get an education and go to college and, you know, do something different. And so we just don't have the workforce that we used to have. And now the people who are in the industry are so busy because after COVID, people stayed home and they started creating their honeydew list, you know, all the things that just kind of went by the wayside when they weren't home as much. And now being home, you know, the fact that paint color on that wall is driving them crazy. And so they need somebody to do that. And so the subcontractors are in such high demand. So of course they raise their prices and they're backed up. But yeah, if you have kids, encourage them to go into the trades. You know, in Omaha, a plumber just starting out makes $80 an hour, you know, without the debt load that a doctor makes. So, and I think that's only going to keep increasing. So,
But we do have a few questions, so I want to get to those here. But again, just I want to formally thank you, Jerry, founder of Dream Vesting Capital, for coming on and sharing your insights. And let's get to some questions. And in fact, the first one is mine that came to mind as I was thinking about the pictures that you were showing. When you go into rehabs or you're evaluating a property, do you eliminate anything that has structural elements to it, or will you get into something that needs a big structural fix, or how do you view that kind of thing?
yep. So it depends on what we're doing it and what the margins are. You know, we can fix any structural thing if the price is right. So it all depends on the numbers. Now there are a couple foundation issues that we tend to just stay away from because the fixes are cost more than the value of the home, and it may or may not actually fix it in the long run. So we will stay away from a couple things like that, but for the most part, if the numbers work, you can fix anything that's structural. So we always say the uglier the better. You know, we like to bring back properties that most people would shy away from. So I don't
Okay.
recommend that for somebody first starting out, though. I should preface that. If you're new with real estate investing, don't do anything structural, you know. And I'm married to my contractor, so I trust him. But if you're just hiring somebody, you don't know how experienced they actually are. Unfortunately, people don't always tell the truth about their experience. And you don't want to hand over a major structural issue to somebody that you've not worked with before and you don't have the deep enough pockets to, you know, maybe have to redo it.
Sure. Next question is, what made you believe in staging? You mentioned, I think, that you stage the properties that you sell. What made you believe in that, and what do you think is the value in it?
So my simple answer is go tour a new home community and go look at the models and then go look at a finished home that's not staged. And you will see the difference. Watch HGTV. They stage all the homes when they're done. People, I heard a statistics once that less than 10% of people can see beyond what is actually there. And so if my house looks like you could move right in and it looks cozy and it looks, you know, like what you would see on HGTV today and it smells good. My realtors bake cookies at their open houses in the oven so that the smell permeates the whole home. You know, it makes you want to live there. We get easily 10% higher offer on every property we sell if it's staged. So we spend the money because it's definitely worth it. And no, I do not do the staging. I do not have an eye for that. We hire a company that they do all of our staging and they're amazing. You can imagine some of the old houses we flip have really random rooms or, you know, somebody did something weird in a room and I'll call them up and say, well, we painted and carpeted it, but you have to come make sure that make this thing look like it belongs here. And they do. They figure out something.
Nice. Okay, next question. And Corey, I'm gonna ask you to go ahead and weigh in on the IRA question, so I'll just keep reading then.
Of course.
Here we go. So I can purchase a $200,000 property, $150,000 from my Roth IRA and $50,000 from personal funds, and have a 75-25 split between the two.
That is correct. You could purchase a property with any percentage split, similar to that example of 75-25. And keep in mind, as I mentioned during my part of the presentation, that means all of the income of that property and all of the expenses of that property must be paid and or collected at that 75-25 split. So let's just say you generate $1,000 a month in rental income, then 750 of that dollars goes back into your retirement account. 250 of those dollars goes into your personal pocket in that scenario. Likewise, if you have landscaping expense of $100, 75 must come out of the IRA account, 25 must come out of your personal pocket, and you have to keep the basically the bookkeeping and the math on that all accurate throughout the duration of ownership of the property. But again, you can partner with yourself, you can partner with any colleagues or business partners. That's all allowable within the IRA, so long as you go into the new property purchase with those new owners being set and that percentage being locked in.
Yeah, and I'll just add on to that in as much as please do contact Corey or myself if you have a scenario that you want to vet a little bit in terms of the way the IRS looks at it and the mechanics of it. Obviously, we don't give advice in terms of investment, but we can tell you how the IRS looks at the account types and what kind of participation they can use. So please do use us as a resource. Okay, next question. Why wouldn't the homeowners, this is for you, Jerry, from maybe a little bit at the beginning of the presentation, why wouldn't the homeowner sell the house via retail instead of wholesaling it? How does a house get into wholesale, I guess is the question.
So since I'm a broker, I have a duty to the public. So the way that my agents, and there's a lot of different ways that you can do it, but the way that we do it is we go to the homeowner and we say, here's our numbers. We could pay $70,000 for this house because it needs this much work and we're going to do this with it. And here's what we'll make for a profit. If you put it on the market today, we could easily sell it for $85,000. And the biggest response that we get is, I don't want to put it on the market because I don't want people walking through my house. I don't want to clean it. I'm embarrassed of it, whatever that is. They just don't want that hassle. I had one of the homes I showed in the presentation actually was an elderly lady who had an adult son who had mental handicap and was not always safe around strangers. And so she couldn't have people walking through her home. So I made her an offer and she told me what her bottom line was, and we were close enough that that's what the price she wanted was what we took. And she could have made, I think, 15, 20,000 more on the market, but she would not do it. And she was grateful that we showed her, but she had the number she wanted and that's what she took. And so normally that's the reason. Another big reason is that people want to close fast. So maybe it was a house they inherited and they just want some money from it. They don't want to deal with it and they're looking for a cash investor who can close in a few days. Maybe it was a divorce situation and they're just over it, or there's too much work, and they don't want somebody renegotiating the price or coming back and asking for repairs, and they just have a bottom line, and if our number can work with their bottom line, that's what they want. And they don't want the hassle.
Got it. Next question. What's considered a good cap rate?
Well, that depends on the type of property and the town you're in and the area that you're in. So I can't tell you that. I can give you some examples. In Omaha, on a rental property, a good cap rate used to be double digits. Pretty easily, we were 10% and higher. Today, on a good rental property, we can be as low as in the 6% on a single family home. On multifamily, is as low as 4%. If we're in like a rougher neighborhood, we used to be 12 to 15% cap rates, and now we're 8%. So they're all over the board, but that's probably where a good investment realtor would come in handy for your area.
How do you get access to the pro forma to calculate numbers? I think you offered that, Jerry. Would you mind letting them know that again?
Yeah, you can see my contact information here. Just go ahead and shoot me an email, or even text is fine. The number on there is my cell phone, and you can text me your email address and I'll send it back.
Okay. And there's a question on the wood flooring and the floor. So the basic one is what's your favorite type of flooring to use? The person couldn't hear it when you said it on the broadcast, apparently.
Yep. So my favorite is wood. We don't install wood though because it's expensive, and especially today, it's really expensive. But if there is wood anywhere in the house, even bedrooms, we will finish the wood floors. People can always put a nice rug in their bedroom, but wood lasts the longest and it's beautiful. If there's not wood or it's too damaged, then the next thing we do is vinyl plank. And there's levels of vinyl plank and there's colors. You can get luxury vinyl plank today that looks like wood. And as a realtor with 21 years of experience, I have to touch it sometimes to tell what it is because they've done such a good job with it. The benefit of the vinyl plank is that if you get a scuff or somebody scratches puts a hole in it, you heat it up, and so the glue that it sticks to warms up, and you can pull that one vinyl piece out and replace that one piece. So you don't have to do the whole floor.
Interesting.
Mm-hmm.
Next question. Can a realtor flipping a property through their IRA be the listing agent if no real estate commission is being paid to the listing realtor? Commission only being paid to the buyer's agent, not the listing agent. Corey, do you want to field that one?
Yeah, I'm happy to take that one. So that is a question I actually hear a lot. I served as a client account manager for Advanta for about 5 years, and I've seen this scenario play out. As long as you as the agent and IRA account holder are not accepting any commission and either deferring it to the other end of the transaction, or it's also technically allowed to just defer it to your brokerage. As long as you are not personally gaining from the real estate transaction and your position within that transaction relative to your retirement account, that would be okay. I will preface that answer as well, or bring up to that answer as well. Please consult your own professionals for your own due diligence, just for good measure. But in our history and experience, that would be allowed so long as you are deferring all compensation either to your brokerage, to the other end of the transaction, or just leaving it at a zero figure in that case.
Okay. If I partner 50-50 with my IRA and buy a vacation rental, am I able to use it personally 50% of the time? Or
If only.
it's such a logical question.
Yeah, if only. No, the answer there is per IRS rule and regulation. If it's owned even 1% by your retirement account, you are prohibited from benefiting from that property, which means using it for even a day or a weekend until you fully distribute the property out of the retirement account to yourself as an individual, and the IRA no longer holds any portion of ownership there, unfortunately.
Yeah, it's one of those places where logic is not living, because it would make so much sense. Next question, and I think that we'll make this the last one because we are just a little over an hour. And so I want to be respectful of everybody's time here, but we do have this one more question. It says, it's talking about the number of flips that you've done. And the question is basically, are you willing to share, did you have some flops, and what's your batting average there?
Yeah. So believe it or not, because we control so many aspects of the deal, we've never lost money. We have had to reduce the profit to the construction company in order to not lose money on the investor side. So we have some advantages in that, to be honest with you. But we have come really close a few times to losing money. We currently have one that I'll tell you one we currently have. It's not actually a flip, although we probably will end up selling it. But we bought this converted 8-plex in Lincoln. So it's, again, used at one point was built as a single family home, and many years ago they chopped it up into apartments. So 8 units. It was advertised on the MLS as a duplex, and we bought it for $52,000. It had not been lived in for 5 or 6 years. The roof had such a hole in it that 3 floors of flooring were rotted through. To give you an idea, we should have not bought this property. We should have torn it down or something. Our initial rehab budget was like $250,000, maybe $300,000. And of course, we got in with the city, and they went so much more done than what we had hoped to do. So our rehab budget became $500,000. And the city said, we're offering this new program, which is called a mini TIF, which is tax increment financing. In a nutshell, when you improve a property, the difference between what it will be versus what it is today, you pay the taxes to the city, and then they basically pay off this mortgage that they give you, and that's called tax increment financing. It's a much longer explanation, but text or email me and I'll tell you. So anyway, we go through this process with them as like their guinea pig for the program for $50,000, thinking, well, $50,000 is $50,000 when our budget's this much higher. It finally got approved right about the time that lumber and everything skyrocketed. Our budget now is $670,000. And I just want to cry. Like, literally before this meeting, I had a meeting with my project manager about it, and I'm about to have a meeting with my lender to see what we're going to do. So those things happen. Another one that I would call a flop is another house I actually showed in my slide. So with the IKEA kitchen, we were so proud of that house. It was beautiful. We bought it as a short sale. So of course, a short sale means that the seller was very distressed and they don't give you any information about the house. But we bought it, renovated it from top to bottom. The people move in and they call me. They're taking a shower, running the laundry, running the dishwasher, and literally poo backs up in the basement bathtub. It all backed up into the basement bathtub. And we'd never had that happen. We never had any issues like that, but we immediately sent someone over. It took three different plumbing companies to find that in the middle of the lawn, there was just this little tiny jog in one of the pipes. And it was enough when they did that much water to cause it to back up. So we didn't have to pay for the fix. Maybe you guys wouldn't, if you're just doing the occasional house. They had a home inspection. We disclosed everything we knew. It wasn't something we hid or knew about, but we went ahead and fixed it. And in the long run, I think we made just over $6,000 on that one. But we always do since we're a company and we do such high volume, we tend to fix everything that that happens like that. But that was pretty bad. Like these poor kids, I think it was their first home and they were so excited. And then they sent me a picture. Oh my God.
Oh, boy, that's a good story to end on. All right.
Yeah,
So,
welcome to real estate investing, everybody. That stuff does happen. It does.
all right. Well, Jerry Schlickburn, founder of Dream Vesting Capital Group, thanks so much. I really appreciate it.
Thanks,
It's always
Ray.
a pleasure talking to you, and thanks for bringing your expertise in the photos and all that stuff, and for offering people the pro forma. And I'll also just mention, her contact. She's allowed us to put her contact information up on the screen, and she's willing to, answer questions and kind of give you some more information as needed. So thank you for doing that, Jerry. I appreciate it.
Yep, absolutely. Thanks, guys.
And Corey, always a pleasure, my friend. Thank you for your taking over the nuts and bolts of the IRA part. And for those of you who joined us today, thanks a lot for spending some of your time with us. I hope that this was helpful in terms of conceptualizing and executing your IRA real estate investment strategy. We do have a lot of events, both webinars that are live like this, as well as some things on our blog and other types of education that you can use to help to educate yourself and hopefully make the best investment choices that you can. So thanks a lot for spending your time today. Have a great and safe day, and we'll see you on the next one.
Thank you, everybody.